10-year bond yield is close to 7.1%. You can also read this news in such a way that the government of India is taking loans from the market at the rate of 7.1%. These loans are taken by issuing bonds. Now, what happens is that the government issues bonds maturing at different tenures and investors buy these bonds. Those who buy bonds get assured returns till maturity without any risk. This return is called yield or coupon rate of the bond. The coupon rate remains same till maturity. However, yield keeps on increasing or decreasing. Banks are the major buyers of government bonds. But now, you can also buy these bonds. In effect, you give loans to the government. That is, you also have an investment option where assured returns are guaranteed without risk, just like in bank FD. Now, let us understand how you can buy bonds. Government bonds can be bought directly through the Retail Direct Gilt scheme of RBI. Under this scheme, investment can be made by opening an account for free. In November 2021, RBI started this for retail investors. From here, you can buy government bonds as well as bonds of big government companies like National Highway Authority of India, Power Finance Corporation, Rural Electrification Corporation, and Indian Railway Finance Corporation. Private companies also raise money in the market through bonds. You can buy these with the help of your broker through trading account. Apart from this, some fintech companies are also offering the option of investing in bonds. Among them, JM Financial Bonds Card, Northern ARC, LTIF, Vint Wealth, Cred Avenue, and Zerodha are some prominent names. The price of bond generally starts from 10,000 rupees and goes on to be in lakhs. The risk is higher in case of bonds of private companies as compared to that of government bonds. The rating agencies give rating to the corporate bonds on the basis of risk. The lower the rating, the higher the risk. And where the risk is high, the return is also higher. Now, understand why now is a good time to invest in bonds. To curb rising inflation, the process of increasing interest rates has started. The country's largest public sector bank, SBI, has increased interest rates on all type of loans. That is, the RBI may not change policy rates, but the loans have become expensive in the market. The debt will become expensive, which means the yield of the bond will improve and you will get good returns on your investment. Right now, the yield of 10-year bonds is close to its 3-year high, and it is likely to remain at the upper level. If you don't want to invest directly, then what are the alternatives? So, instead of directly investing in bonds, the small investor has the option of investing in bonds through the debt mutual funds. Avinash Gorakshar of Equity Research Advisory, Profit Mart says that retail investors are able to diversify their investments through debt mutual funds by not investing in just one bond. But if you don't understand the risk and returns associated with bond and can lock your money for a long time, then you can invest in bonds. Don't expect very high returns on bonds. You will earn regular income in the form of interest, but choose the bond only on the basis of credit rating of the company. Companies that do not have good credit rating may pay more interest, but there is also the risk that firm could default.